ready to take notes because coming up, we have Matthew Timpane. He's a CMT, senior market strategist with Schaeffer's. I'm excited to get Matthew on, and he's going to be able to talk a lot about this volatility that we were just talking about. I mean, today is a great example for how volatile these markets have been, but you don't need to just look at today. You can look back at the last 3 months or so, and see that it seems like every move we've made, we can't hold it. Matthew, how are you doing this afternoon?
Not too bad for yourself, Aaron.
Pretty good. And I got to ask, this might not be great, practice, but is it Timpane? I don't know.
Yeah, it's Timpane. Trust me, I've heard it all, so it doesn't bother me. But
what's the weirdest you've heard?
The weirdest. Here it is. Hopefully, I don't get in trouble. I had it was actually in a women's studies class of all places too. A male teacher during college called me Matthew Tampon in the middle of class.
Oh my!
And it was. I was like, oh my God, thank you. My face just turned red.
Well, that's what he gets at being a male teaching a women's studies class.
Yeah, and I don't get embarrassed very often, but the environment was right. It was. I think I was the only second guy in the class, and it was one of the requirements for the school. And I was like, oh, come on,
All right, Matthew. Well, you want to give us a quick rundown of what we'll be talking about today?
Yeah, so today we're just going to kind of go over what the market environment has been presenting to us and how we're really kind of navigating the volatility with options here. Talk about what's kind of working, what's not working, and then just kind of give a little bit of an overview then on the broad macro side on the end of it to kind of see where we could be going and what where we could maybe go from here actually. So.
Hell yeah! Well, I'm excited. I'll let you take the floor. We'll be hanging out backstage should you need anything, but I doubt you will. You're a pro, Matthew. Take it away.
All right, wonderful. Well, thank you everyone for joining us here today. As they said, my name is Matthew Timpane. I'm a senior market strategist over at Schaeffer's Investment Research. We've been around for 40 years, navigating the options market. So happy to be here talking to you about the markets and what we've been going through. So the market environment is definitely been tricky for a lot of new traders. So if you're just getting into it, or if you've been into it for a little bit of time, this is probably a big, first down move that you've really seen. So you hear about things like we're in negative gamma territory, and just in a very simplistic way, what does that really kind of mean for us? In short, it just means that market makers are short gamma and have to trade with the price to remain hedged against their positions that they've sold to, speculators. So when the price, what this does is there's more room for potential squeezing, whether it's to the upside or to the downside when you're in this territory. So if prices rise, they look to go long to hedge. And if prices go down, they look to short to hedge. I believe right now, I looked this morning, the GEX flip point, which would bring you from negative to positive gamma, was around 39.02 when you kind of use a combination of the SPX and the SPY options. So that's where you would probably re-enter, a nice, more positive gamma territory where you'd have less volatility. And we're also in, obviously, when you're in that kind of territory, you're in a higher vol environment in general, and you have high implied volatility for your options contracts. So whether that lasts, years or months, this is just the environment that we're in on a relative basis, and it provides poor leverage compared to, the positive gamma environments. This doesn't mean you should discard options, though, but rather you need to adapt to the market environment that you're in. In this environment, price of the security is going to do more of the heavy lifting for you to get your contracts to your targets versus, kind of the baked-in leverage that you normally had. So this is where you will also see some at-the-money contracts have lower than the 50 delta that typically is there. So deltas kind of get out of whack. And then, the last kind of, just to touch on it, the last prolonged high implied environment that we really had was during the great financial crisis. So it doesn't come around long that it sticks around forever. But that did have lasting effects kind of out until 2012, where we once again entered, a nice solid bull market range, average in implied volatilities. We're also, we've been experiencing a very bifurcated market. People say that it sounds smart. Really, it's a simple term. You approached a fork in the road, and one went straight up and one went straight down, basically, in a way, right? So a lot of people haven't seen that that have started trading recently. So that's the type of market we're in. We saw inflation-sensitive assets continue higher, while assets that enjoyed the easy money have absolutely cratered over the last year and a half. If we're truly going to go into a recession and have another huge leg down, you're going to see all assets collapse at that point. So you'll want to watch commodity-related stocks and how they act in the next few months. Would be my indicator of kind of where we're going. If they're not collapsing and they're holding up, even if they get pullbacks, we could be maybe entering a new bull market. But if they start collapsing, we could still be in a very bad environment for the next few months, even into maybe 2023. So that's where I would be kind of taking a look. Today, we also got the first ever 75 basis rate hike, while equity markets have actually been in a technical bear market. I can get into that, but I think, there's been many sectors, obviously, of this market that have been in a bear market. So I don't believe necessarily in that 20% rule, but it's the first time that it's happened. As you know, rates have been driving kind of the headlines in the markets. The 10-year broke out above 3.2%. I think we're currently around 3.4% if I'm correct here. The 10 and 2 yield curve inverted once again yesterday. The last time that it did that was kind of intraday back in March. But the fact of the matter is in modern times, when we've had that initial yield curve inversion, a lot of times we've still got a great bull rally after. So you got to keep that in the back of your head. Maybe it's different this time. Maybe it's more of the 70s and 80s environments, obviously with the high inflation rate. But we got to just kind of have these kernels of information in the back of our head. So as traders, we can be ready for whether we need to go long or we need to go short. Typically there's a lag within the yield curve inversion of 6 to 24 months. It doesn't happen instantaneously. Markets don't roll over instantaneously, and the recession doesn't happen instantaneously. So it's just things like that. You want to kind of know where that is. And here's a chart of the yield curve inversions. As you can see, they have been great recessionary indicators, but there's always a little bit of a lag. And the big one that I would really look for is that 3-month. So that is still kind of holding up in rising rate territory, which have typically been still indicative of bull markets. You usually need to see that invert. So even though we're in a cyclical bear for right now, there is still some hope there. And finally, dollar dominance, king dollar, the destroyer portfolios. It's broken out of this range a little bit. What you're really hoping for, if you're a bull on the markets right here, is you're going to see this dollar pull back. I don't know if that's going to happen. I just want to give you the data points here because it's simply, if the dollar continues to rise, you're going to still continue to probably see pressures because you're going to have interest rates rising. So you need some moderation in this for it to begin maybe a rising rate bull market. But the big thing, what we want to focus on here today, is how we're navigating this market. And to start with, it's risk management. So I pulled up a few charts that I usually use in January just to remind traders of what to do and what not to do, starting out the new year and everything like that when we're coming into the markets. Maybe we got loose on some of those mistakes. So I pulled a few of those from that presentation just to share with you today. You got to target your entry and exit points and with pinpoint accuracy, even more so in bear market environments. So dig down on the charts for targeted entries. The truth of the matter is, in a bull market, you're going to get away with sloppy entries more often. In bear markets, I would argue, we've obviously been in one for a while, as I've said, in many ways. So in bear markets, you just don't get away with that. You can have, a 4% move in a day. So I'm not saying you need to go down the 1 and 5 minute kind of time frames. If you are that type of trader, that's fine. That's perfect. But at least dig down to the 1 hour and the 4 hour and confirm that, that daily, what that daily chart is kind of showing you there. You want to be able to kind of view it on a multiple time frame, lining up, in your direction, in your favor. Second, take half off if you hit your price target. This isn't the time to be a hero. This is the time to, this is the time of survivorship here. You don't want to be the one that's sitting there going for the moonshot so you can brag to your friends. We're trying to make money in these markets, plain and simple, whether they're bear markets or bull markets. So take half off, and let the rest kind of ride, set a nice little stop as we're going to talk about here, because the simple fact is one headline can flip that P&L upside down. in this environment within a day or even two. So I've seen it in some of my own trades. I've literally seen the ones, if I wouldn't have taken half off, it would go from 130% down to negative 30% in 2 days. So, take half off and then, honor your stops. I can't preach that enough to new traders, existing traders. Honor those stops. Losing is part of the game. If you got a win-loss rate right now, just say of 50%, especially in this environment, you're doing better than the majority of traders out there. And I'm even counting the best of the best. In this environment, it's extremely tough, and the way to win is through risk management. What do I mean by price stops? With option contracts related to that, somewhere between 30 and 50% is what we look for. And then time stops is usually what we call half-life. So the date that you entered the option to the date of expiration, put a date on your calendar. That's half-life. If the option isn't acting correctly, if you're in a small profit only, or if you're slightly down on it or around break even, and it's just not working, you can roll out to another month on your option expiration, or you're also wasting opportunity costs. Go move on to something else. So diversification is the final one here on risk management slide. Many new traders, really were pulled into growth stories in 2020 and 2021 for part of the year there. That's all changed. And many new traders haven't lived through a value-oriented market. While I'm on the younger side still, or at least I like to think I am, I've been lucky enough to trade through multiple environments where growth really isn't the only trade out there. So sometimes, you got to get dirty, get into the commodity space. Right now we're seeing things in healthcare. Some look good and some look bad. You got to find those parts of the market where you can find an edge and find a trade. And then another slide that I use a lot of the times to talk to people is, you got to let your profits run, cut your losses. You might not be able to let your profits run as much as you had in the past, but that doesn't change the simple formula for success here. You can have a 40% win rate as long as you're having an average win on your option contract of 80%, and have a 60% loss rate, as long as you manage that risk and that loss is 35% or 40% even, you're going to still be profitable. It's much better than having a great win-loss rate of, 60 or 70%. Versus a 30%, 40% loss rate, but you're not letting your winners run and you're letting your losers grow larger. So it's all about cutting those losses and letting those winners run and working with it. And then finally, just kind of on this aspect of, don't misallocate capital right now. This is not the time to get extremely concentrated. Take a smaller trade. If you've had 6 losers in a row, that happens, especially in this market. If you look at this chart here, you can have, 6 losers in a row, 62.6% of the time through certain trading periods. It happens. And you can't say, well, I've lost 6 in a row, let's go to number 7 and bet all in on this. That's a quick way to blow up your account, because you can still lose 42% of the time on that one. It happens to the best of us. And the fact of the matter is, just keep your sizes small right now. As you're going through a volatile market, you will find success as long as you manage that risk. Stop out of your, when your alerts go off, and let your winners kind of run, and then take profits along the way. So volatile market adjustments. There's a few other things to the aspects of it. I remember when I joined Schaeffer's Investment Research, our senior VP of research, we were talking about this during 2018, I believe it was the bear market there, where we were, kind of, pulling back into Christmas time. It was Q4, pretty bad bear market from September that year on forward. And I was making some trades and adjustments. I was shortening my time frame and lengthening it. And our senior VP said, when we're in volatile markets, that's typically 2 things that you can do. You either shorten your time frame to hit your objectives, or you lengthen your time frame. So when you're shortening it, you're looking to hit that winner and that move a lot quicker. And when you're lengthening it, you're hopefully getting closer to the bottom of the market if you're getting bullish. And the reason why you lengthen that time frame is you're going to have increased time decay, because time premium is going to come out of that contract when you have an IV crush, and you're going to want to give more time to that trade to work for you. Another thing is just tighten your stops and take profits quicker. It's okay. We usually typically target 100% on our options trades or 200% on them. But in this environment, if you're seeing a stock stall out and you're at 80% or 90%, don't be afraid to take the profits right there. Take half off, again, set the rest for break even. At least you walk away with 40% profits. And tighten those stops up so that you adjust for that factor on your win-loss ratio so the math works out. So if you're going to tighten that kind of target a little bit down to 80, instead of having a 45, 50% loss where you take the stop, target that down to 30, 35, 40, at least. Another thing is sell a little bit more premium. We're in an environment where it's better to be seller in premium with high implied volatility, versus buying premium. So it does lend to the seller a little bit more in these environments. When you get those rallies, the IV typically gets crushed. So your bullish bets will have both price and IV reversion to the mean working for you. And your bearish bets will not get crushed as much on those rallies because IV will come in. So even though it's working against you, you'll be able to manage risk. If you want to stay long premium, buy deeper in the money. If you buy a little bit deeper in the money, you offset some of that decay for any potential IV crush that you may have because you're playing with more intrinsic value. So these are just some adjustments that you should make when we're in a volatile bear market like we are. So what's really working? I look back and saw some things from my personal trading and from what we've been doing as a company. Credit spreads are working, as I mentioned, selling premium. Managing the risk, though, in a coordinated fashion has been crucial. This is an environment where you're just going to sell a bullish credit spread and expect it to go to zero, by expiration, because you can see what happens. Risk happens fast. They're going to hit that, and then you're going to be at 100% loss on it. So you're going to want to de-risk at, like, say, 50% profits, maybe a little bit more, and then set an appropriate stop for the rest. And then, in general, a good rule of thumb, if you do sell some premium, if the credit that you collected doubles, get out of that position. You can always re-enter it at a later date or take a different trade. Debit spreads also are pretty good in this type of environment. So if you want to be long premium, we're in an environment where it's really tough to let convexity run a lot. So selling that upside call against the call option that you bought, it caps your gains, but we're seeing these support resistance zones kind of act as magnets, and that's where they kind of fail. So you likely, unless we break out, you're not going to lose that much upside to doing this. Another reason to do this is actually when it trades against you, it's going to trade against you at the rate of the decline is going to be a little bit better for you because you have sold that call against it. And that way, instead of being maybe minus 60%, you're going to get out maybe at minus 40% instead. Another thing that's been really kind of working for us at least is 1 to 3 week in the money directional bets. It's been one of our better performers because we've just been trading so rapidly in different directions, up and down throughout this whole year. At the money actually has worked at the 1 to 3 week directional level as well, but it's worked a lot better on the put side than it has on the call side. And that's because, you have, every time we get a rally, you get the IV crush and, it kind of just takes away from those gains on those calls. So look at that. Our bread and butter typically is swing trading, anywhere from 2 to kind of 5 months. And that's been a harder area, obviously, unless we're in some puts that we're just holding. Definitely hasn't been the easiest place to be. Pair trades have started to kind of work better here in Q2 with the big moves, for us at least. This is where you're trading two correlated securities from the same sector, but one you're taking a bullish viewpoint on, and the other you're taking a bearish viewpoint on. Kind of is a more conservative take. Sometimes both legs will work for you. That's great. If they don't, what you're doing is you're hoping that maybe your put side is working, your call side is going to zero. You're going to want to look for like a 200% gain on that pair trade. That way, you're still getting like a 50% return on that. So that's another way to kind of just play this uncertainty at time. And then straddles. Straddles are really tough to play in the bear market, but we have seen a little success when we've been able to get these consolidation zones, right, where you get the implied volatility crush, and we're losing a lot of that IV. Granted, it's not going back to where it was, but then we have the uncertainty. Are we going to break out maybe in a huge bear market rally, or are we going to break back down? So they've actually been working. I just would caution that you really take the time. If you're going to put a straddle on, you make sure we're in a nice tight consolidation pattern. You've had the IV crushed, because otherwise, you can't put these on in the down move. You're going to get crushed when the IV eventually comes back out of the options. So those are the ways that we've been managing it. Let's just kind of take a look here at the markets from a broader aspect. Oh, for some reason, not moving. I do apologize about that. So the next thing that we want to look at is the S&P 500 here. We're really at a crucial level to hold for the S&P 500. If the 10 and the 12-month kind of moving average is the guide to portfolio managers and trading, for volatility, it's the 36-month moving average that has been a major pivot level that has largely defined if we should be buyers or sellers of the market in the long term. We do see the historical volatility and kind of pulling back now from that 30 level. That's a good sign for bulls, but we do have some correlation here with gold that is kind of around the 1.0 level on the 50-day basis. Typically, we still see some volatility at those levels, so that's why I have those on there. Let's pull this up to the kind of the smaller basis and just kind of take a look at this. I got some levels here that we've broken down from. Real risk here is to the 50% Fibonacci level. This is where we have the 340 and the 345 strike in the SPY as the largest strikes. This is where option traders are kind of positioning that the market can stay above or trade even down to, which aligns, like I said, with that 50% fib level. So really is what you're going to want to do is watch the VIX for a breakdown below 30, which I believe is happening as we speak this afternoon here. The last I looked, it was. Moves above 30 have been short-lived, but have brought powerful down moves to the market. So that's something you also got to keep on your radar when you're trading direction, especially looking at the indexes. If there is one little area of kind of shining light that could be happening for us, we do have July seasonality, which is very positive for us. It's on average since 1950 been positive 1.15%, standard deviation of 3.43. One thing that we always kind of look at is SPX components, 10-day buy to open put call volume ratio as well. The one thing I just want to mention about sentiment, we're huge sentiment people. We look at it, we put it out there all the time, but there is a big difference between bull markets and bear markets using sentiment. In bull markets, sentiment works great. Once you enter the bear market, these levels can remain there a lot longer than normal. And when looking at the put call volume ratio here with the SPX components, we haven't even breached 1.0, which is something you will see when you have massive corrections. So, it's not necessarily, we're going to say we can't have a bull rally here. We're also going to be a little bit cautious on using these type of indicators. When we look at short interest as well from the S&P 500 stocks as a whole, not the index, but we look at all individual stocks, we're starting to finally see some short interest increasing and brewing here. That's a good sign because you need that to fuel any type of rallies, right? We've been at extreme lows over the past, when we look at it from a 5-year perspective, we're still only in 31.6% tile of that. So it's good that we see this growing, but this is why bear market rallies haven't been all that powerful. There isn't a lot of short interest to get us going and to keep the fire, the flame lit underneath that rally where shorts are covering. So very similar kind of setup here with the NASDAQ as well. It's holding a crucial level there at the 36 kind of month moving average, breaking below it right now actually. But as long as we can get back above that, that would be good. These define, like I said, major moves, major pivot levels. As you can see, early 2000, again, great financial crisis. When we break below that 36-month moving average, we could be in a lot of pain. So that's something you want to keep on your radar if you're trading, if you're new to trading. Even though options are shorter dated, you got to pull out and look at these longer monthly, charts as well. They give you a lot of insight to what could happen. Again, pulling in a little bit here with the QQQ. The real risk is breaking that, we already broke that 50% fib level. So the real risk now is bringing us back down to the 61.8% fib retracement level. We're at about the 280 mark right now today. We have a large 280 peak put level right there. If we break that, we have we can easily move down to the 260 strike pretty swiftly, which is the next large open interest strike here when I'm looking at the next 3 months of data. So that is your risk in the short term. Again, similar thing here with the NASDAQ component buy to open call volume ratio. These can remain higher than you and longer in bear markets than you may expect. And we haven't even seen a push again above 1.0, which is really the typical indicator that you get that capitulation type of bottom. Participants are really scared and they're buying a massive amount of puts. With the NASDAQ 100 stocks as well, short interest is also growing. Beautiful thing is the 5-year rank, which was just 0 percentile just a few months back, is now 46.6%. Since the last report was just 2 weeks ago, we saw a 7.13% increase. And overall this year, it's up almost 12%. One thing that we've always tracked, and we saw obviously through a lot of options, since we're an options firm, we saw a huge option kind of explosion, after COVID pandemic lows. This is where the buy to open equity only daily call volume is now. As you know, or maybe heard of, we set multiple records. We set one in January 2021 during the GameStop frenzy. We just set another record on option volume this year in January with 62.2 million contracts. That one had a little bit more put volume, so as you can see, it's down sloping there on the call volume. But now we're below all the levels basically after the post pandemic. So we're kind of reaching towards those lows once again where we were in the middle of COVID. So if you're new to options, these are usually the better times to start learning about it for that next type of bull market that you might be getting into, or when the option market really starts driving back, into market forces here. So this is something that we kind of just look at as a gauge from where's, the perspective from retail traders, and it definitely tells us that, we're starting to finally see some real negative sentiment in them. They're not trying to buy the dip anymore as much as they had in the past. And that can, eventually lead to a new bull market, hopefully. As of right now, we remain in a bear market, and we just got to keep playing it that way. That's it for me today. Thank you so much for having us, and we'd love to chat with you about your options trading. Come over to schaeffersresearch.com. We have great news on options that no other place really puts out. We have education there for you to learn how to trade options, and give us a follow on Twitter at Schaeffer's and at mtimpayne. We're always trying to put out some good actionable content for people to kind of follow along. And if you have questions, feel free to reach out.
There you guys have it. Definitely go ahead and reach on out and hit him up on the Twitter life. I know he's very active. I've seen him on there, so check it on out, guys. Thank you for joining us. And there goes chapter 9, guys. Thank you, Matthew. We'll have you on again.
Have a good one.